All right, FX Street, thank you, and welcome to another webinar at FX Street. My name is Fan Yang. I am the editor and manager, pretty much editor of FX Time, so I'm just going to drop my link over there. You guys can check that out later. But here, for the next hour, I'm going to take a look at the Forex markets, at the technical setups and conditions in the markets. We'll talk about some possible plans we can put in. And at the end, I'll open it up for questions for any other pairs or anything I went over. Okay, so we'll start with the euro dollar. And, we have to begin at least with last week when we had this reaction to the FOMC paper talk, right? You guys should be familiar with that theme. That's the main theme in the U.S. dollar pairs recently. The fact or the prospect of the Fed slowing down its asset purchase program, stop buying bonds, and the market, the dollar would gain. The dollar has been weakened, has softened by quantitative easing, right? And if that's going to slow down, the market consider that as tightening. Whatever the Fed officials say, they say, it's not called tightening. But whatever the semantics are, the fact is that this sort of drug of quantitative easing is not going to be available for the markets, and that would be better for the U.S. dollar, right? Simply from the supply-demand side, right? If we have less quantitative easing, less supply of the U.S. dollar, stronger the U.S. dollar. All right, so we have that reaction, and it has continued to come down. Today, again, we had a little bit of relief rally, and that stalled here before the 1.3055 pivot. I was looking at this morning and seeing that if it did break the 1.3055 pivot, then we're likely to have another consolidation, okay? Sideways consolidation. For now, it's still bearish, For now, it's bearish, and the pressure continues on to the 1.30 level. That's already broken, and if we continue to push lower, our next key support should be around 1.2955. For me, I don't want to, go against this trend, even though it's only a short-term trend, until I see some strong support factors, and I see either the market flattening or showing sort of oversold, bullish divergence type of condition. Okay, so for me, if I just zoom out a little bit, 4-hour chart, and see if you connect the lows in May. Let me just do that more clearly. Yeah, let me draw that again. So this is looking at the lows from May and projecting that. We see price might cross that path when it also deals with the 1.2955 pivot. Okay, so around this area, a little bit lower than now, I would look for a possible reversion back up towards maybe 131, maybe 130, 150. Okay. But for now, the market continues to be bearish, and in my opinion, not oversold enough and not at a key support to try to look for the bottom just yet. Okay. And even then, we should look for the market to slow down in the lower time frame. Even when the market's at around 1.2955, we should still make sure the market, at least in the 15-minute chart, slows down the momentum, the bearish momentum. Okay. All right. So euro dollar continues to be bearish. One idea we can have is that when we look at the 4-hour chart, when we look at the daily chart, the market is more or less sideways, right? In 2013 at least. So there is a possibility of playing some oversold condition. Okay, it's not like the market has been bearish, where we shouldn't try to pick the bottom. Okay, and here you could argue that in the short term it is bearish, but in the 4-hour daily chart, it's more or less sideways. You see this, the moving average, 200 moving average, pretty much sideways, and you can even argue a slight bullish tilt. So, if you're thinking, oh, this is sort of picking a bottom, hey, make sure the market slows down as well. Don't just jump on it if the market's falling sharply towards 1.2955. If it slows down and you consider this oversold, there's a possibility of playing that towards, I would say, first 1.31. Okay, I wouldn't, there's still room higher, but I would be conservative because it is going against a short-term trend. So back up to 1.31 would be my initial target. You might have to put your stop a little lower than 1.2950, 1.2925, for example, just to give it some elbow space. All right, so that's the euro dollar. Let's take a look at the pound dollar, which has been very bearish. We did get some, we got some austerity measures outlined recently, or I think yesterday, and the pound continues to be pressured. Right, in this 1-hour chart, you see it dig lower today, and even within the last couple of hours. Okay, so in the 1-hour chart, it looks like a runaway bearish market. The moving averages are very bearish. The RSI held mostly below 60 and has tagged 30, showing persistent bearish momentum. Okay, so in the very short term, you could look at these pivots, these key pivots, and see that they have acted as resistance. And now they have acted as resistance, at least, where before it was support and then turned resistance. Support, turn resistance. Even this here, you have support, turn resistance. So it's sort of cascading lower and lower. Can we play these pivots again? It's possible, but if the market, if in the 1-hour chart at least, the RSI is around 30, I wouldn't try to chase it. If the RSI comes back up around 60, and this is for the euro dollar in the 1-hour chart as well. If the RSI comes back towards 60, we could consider fading that relief rally, because when the RSI in this time frame, if the market is going to continue to be bearish, then the RSI should hold below 60. But we do see the market push above that sometimes. It's not a law that the market has to follow. It's just a sort of phenomenon that occurs when the market does have bearish momentum. Okay, so if it keeps bearish momentum, and we're thinking more downside. There's more downside, 1.51, 1.50. If we look at the 4-hour chart, or I should say the daily chart, and you connect these lows from the 2013 lows here, first low here, second low here, we connect that. We have 1.50, 1.51 area, wherever that price might meet this trend line. Okay, so we do have some further downside. But, even when you look at the daily chart, you see such a sharp fall. Okay. And you see the RSI here about to drop below 40, showing there's no, built up of bullish momentum. But still, when the RSI drops below 40, you don't have any strong momentum in any direction right now. But it's not a bearish momentum, at least. Okay, so when it does come down to this trend line, we could consider looking for the market to show a bottom and then look for a bounce. But for now, fade the rally, right? it looks like we could fade the rally, especially if the 1 hour RSI comes back to around 60. I'm not sure where that price would be. It could be a market that's sideways. Sometimes the market will consolidate sideways for a while, and the RSI in that consolidation could creep up. Okay, sometimes it will be a sharper correction. Okay, but I can't predict what kind of corrective structure it's gonna be. But the point is to watch out for that correction to develop, and I'd rather play off the top of that consolidation towards the downside than to try to find the bottom and play and try to pick the bottom here. Now, I'd rather, if I'm gonna quote unquote pick the bottom, I'm gonna let the market come to the 1.50 area, 1.50 area, show bearish bullish divergence in the 4-hour chart. On the daily chart, maybe the RSI closing in at 30. Those will be signs that the market's a bit oversold. But for now, it's not even that oversold and has some room to fall. Okay, so that's the pound dollar. Looking at some pivots in 1-hour chart and anticipating the RSI coming back to 60. And we can do that with the euro dollar as well, looking for the RSI to come back to 60. Maybe if price comes back up towards 1.31, we should consider resistance there for further downside. Okay? Let's go to the dollar yen, which has been consolidating choppily. It's going to be tough to call anything inside of this range. We could look for range, the overall range support and range resistance. Okay. Okay, so it's trying to push above this high here. And if it does, for me, it opens up the 99.90, 100 handle. Okay, because if you look at the 4-hour chart, we basically anchored out of this falling trend line, but it's a sideways price action. Okay. So it's not exactly a breakout to the upside, but just sideways shift, a bearish market turning sideways. And there's some short-term bullish bias still remaining. You see the RSI tag about 70 in this 4-hour chart, and that shows establishment of some bullish momentum. But if the RSI can't hold above 40 and come back up to 70 again, if it can't do that, then we just have one swing. We don't have any persistent bullish momentum, especially when you look at the chart and you see that the 200 4-hour moving average is pretty much sideways, and the market is actually under it. So there is no bullish bias at all, and we need to break above 98.70 to establish some bullish, some consistency or persistence in bullish attempts. That should push the RSI here in the 4-hour chart above 60 at least, bring it out of this consolidation. If it's consolidating, it should stay under 60 and above 40. But if it's going to have some bullish bias again, it should come back up above 60. So in the 4-hour chart, that would be a sign. In the 1-hour chart, well, in either chart, you see the price here, price high here, that needs to break. In the 1-hour chart, we gained a little bit of bullish momentum, right? Here, the RSI came back up and tagged 70 today. Okay, so overall, we do have, when you look at the RSI, we do have bullish momentum. And price is trading above the 200-hour moving average. Okay, so I wouldn't say we need to jump the gun and call for a breakout, because it hasn't broken out, and you see traders here actually protecting this resistance. Okay, but if I was one of those traders, I wouldn't look for the market to come all the way down to the range support. just because the prevailing trend in this time frame is up. At most, I would come back here, maybe look at this previous pivot where you had a strong rejection, right? Around 97.80, maybe 85. I wouldn't look past that for the bearish outlook at the moment. Okay, maybe use this trend line as a guide. Okay, a break below that, then I'll be like, oh, the market continues to consolidate and takes away the bullish bias. Right now we're consolidating with a bullish bias, but a break below 97.70, for example, especially if it breaks this rising trend line here, projected trend line in the near term, if it breaks that, then the bullish bias is neutralized. Focus again on this 97 level, but the bearish outlook does not. It should be shelved until a break below 97 or 96, 95 area again. It will break below the 200-hour moving average, and that would also establish a top, and that would at least open up towards this 95.80 to 96 area. That would be the first challenge. And then if we get a pullback, okay, and the market remains below the middle of this range, so let's say it comes back up and stays below the middle, then we would be respecting the top, and then there would be additional bearish outlook. For now, any bearish outlook is very limited. Even on the break, it's limited. But if after the break, we get a pullback and respect of this top, then we could open up these lows down here, the June lows down here. Okay, so dollar yen, I talked about a couple of scenarios. One is, looking at this with the bullish bias that, in this 1 hour chart, as well as in the daily chart, really. You have a bullish bias in the daily chart as well. You're holding above the 200 moving average. But you know what? You lost momentum in the daily chart. So in the daily chart, it would be bullish / neutral. Okay. In the 1 hour chart, it's also bullish / neutral because it was bullish and it turned neutral. But you have that prevailing bias of being bullish. So if we're going to take that bias and build on it, and you see this price coming down, you could plan for a bullish attempt again around maybe 98. Okay, 98, but you might have to put the stop under 97.70. Okay, so you have to consider the risk involved of being wrong, and then the potential of being right is we do continue higher. We break above 98.70 and head up towards, first stop would be 99. Okay, and then you might have to wait for a pullback or some confirmation swing, and if that confirms the market respecting this consolidation, then it can move on towards the 99, 90, 100 area. I make the trend line to wick mostly. I got a question from Mr. Mark C. Whatever. Yes, I do use wick to wick, but for me the trend line is not like a magic line level, and sometimes you have to adjust it a little bit just so that it caters to more of what different market participants might see. And like for example, the sideways one, there's a range of it. It's an area, not just one sideways trend line. That applies to rising or declining trend lines as well. For me, I draw the trend line, but in my mind, I give it a body, I give it some elbow space, and if someone else draws the trend line another way, I don't discount it, but I look at it as another possibility that you have to consider if there's other people looking at other trend lines. They might be making orders slightly different, and that can affect the market. So you want to make sure you cater to not just one very specific way of drawing a trend line, but allow a little bit of wiggle space. Okay. And yeah, don't treat the trend lines like they are magical entities neither. They're just sort of a guide in a chaotic sea. You sort of just have a guide there that's moving a little bit. It's a little bit dynamic. It's not completely set. Okay, so moving on to so dollar yen. Either wait for the breakout or play some bullish bias in the middle of this range to the downside. If the market breaks down, I would actually wait for it to come back up first, and then look for the swing, and then try to catch the next swing down. Okay, because it's against the trend. As far as into the trend, I would be okay to jump the gun a little bit and play the breakout swing, but against the trend, I'd rather play the confirmation, the swing after confirmation. Okay, so that's just my, I guess, little strategy there on how to deal with different scenarios of the breakout. Here's the euro yen, and this was a market where it was a little easier to call back here when the market. Let's go to the 4-hour chart. When the market here couldn't break. Let me just draw the little resistance here. Couldn't break above this trend line, projected trend line, right? The RSI tag 70. Okay, so even though there's some bullish momentum established here, we couldn't push through. There was a resistance, and we saw some volatile swings after that, down, up, down, up. Okay, but that started to create another channel coming down. So we came down from this resistance, and then the market created some further resistance that the market respected on its way down. Now, after creating those falling resistance, so here is an example where the trend line, it's not clear, right? It's not clear for the top at least. Okay, and I would just continue to adjust it after the market made these new highs to the way that makes sense to me. So yes, there's a way, I do have to make it make sense to me, but the way I make it make sense to me is have sort of an area for this falling resistance trend line. So it's not a trend line, it's a trend resistance area. And that area broke in this 1-hour chart, right? You see also the RSI break above 60, so it's starting to show, not that there was any strong bearish momentum, but it's starting to show that whatever weak bearish momentum it had, it's broken. Okay, price, especially with this wick here, we saw in the yen pairs, the dollar yen, euro yen, it shows the market wants to sort of establish a bottom here. Has it established a bottom? I'm not sure. The market has been making very clear lower high, lower low, lower high, lower low, lower high, lower low. Oh, this low slightly lower, but pretty much the same as the previous low, still within the bearish structure. And then again, lower high, lower low. So the structure continues to be bearish even though it broke above this factor here, this trendline factor. Okay, so it hasn't broken all the bearish factors yet. Okay, the RSI has, did break the bearish factor. Price pushing back above the 200-hour moving average is sort of considered neutralizing the bearish factor, but we just need one more, which is a break above 128.40, let's say 45, which would break this pivot. If it breaks that pivot, I'm more confident to buy on a dip. I don't feel good about simply buying on the break because the mode of the market has been very choppy. Now, of course, the market can go from choppy to being very trending, very sharp, But I can't predict that. I can't jump the gun and say, okay, from now, just because the structure broke, the market has to be sharp, bullish, and very sharp. We have to remember that we still have a trend line to break up here. So before the break of that trend line, I'm still thinking this market is very choppy. And in the choppy market, if you're bullish in the choppy market, the idea could be to buy on a dip, right? If you're bullish in a very trending market, or you're predicting that this is going to have it's going to be a trend now instead of this choppiness, then you might be able to buy on the break. But then what happens when it comes back and becomes choppy? Then you're going to be stuck with that position. It still might work out, but you're going to be stuck with that position for a while. You might see it in the red for a while before it turns up. And in the meantime, you're going to have to risk a lot. At the moment, I'm not exactly sure what to risk. I would say when the market comes back down like this, around 127.50 area, I might start considering a buy around this area, maybe a little higher. And where do I put the stop? At least below this pivot here at 127.40, maybe even below these couple of pivots. So maybe 127.15 area. Okay, so you might be risking 40-something, 50 pips in anticipation of the market returning to these highs, which is just below 130. So let's be conservative and say 129. This pivot is 129.20. So 129 from this 127.60 area is 140 pips. So you do the math. You know what the risk and reward will be. Okay, so this is looking for the bullish break to offer a pullback and going for the next swing. We don't know if it's going to break out, but 129 would be a conservative target. I think if the market comes up and you see that it's struggling with this trend line, you might want to lock in, either break even or lock in some profit. Even though that would give it less elbow space to operate, at least when you're facing that uncertainty, and when you're facing that uncertainty and you can still lock in some profit, I would say do that. Okay. All right. So yes, yen pairs appear to be bearish, or you mean bullish or bearish? Yen, at least in the last couple of sessions, have been bearish. So yen crosses, they've been consolidating like this, like the dollar yen, right? Sideways, euro yen consolidating with a bearish bias. Now let's take a look at the pound yen, which also is consolidating with a slight bearish bias as it makes lower highs and slightly lower lows. Okay. But I want to drop back again to the daily chart and see that we're basically at the crossroad right here for the pound yen. Okay, we're testing support here, this trendline support, and we're pretty much the current resistance is pretty much going to match the falling resistance. So if we break above the current resistance at 152, we break above the falling resistance here, and that would make it a bullish continuation signal. All right, seeing that this trend continues to be bullish and this trend line is still intact, then a break above 152 opens up some pivots up here, 154.80, 156.75. Okay, so it will open up those highs. But go back to the 1 hour chart. If we if we don't come back up, we break below 149, for example, then we might be, well, first of all, that opens up this 147 area. Okay, so if we get a pullback, okay, that sort of respects this area, respects this trend line, it might crack it a little bit, but if it comes back, let's say it stays below 149.50, sort of like a pivot area here, then I would say we could look for another swing towards 147. And then that really opens up the bearish market if the market breaks below 147. Right? When we look at the daily chart, we see that the break below 147 would open up at least a 200-day moving average. Okay, and some of these pivots down here. Now we have 38.2% retracement at 142.24. So there are some room to fall before some retracement levels, 200 moving average. And I would say at that point, my most aggressive target would be still limited to 50% retracement and this pivot here around 137.75. And I'm not, I wouldn't anticipate the market being able to get there in one swing. So you do have a chance after the break to look for another pullback to fade. Okay, but the initial break, now we'll look for the market to come down to 146. So a break of 147, it should come down to 146 or maybe a little lower towards this 200-day moving average. And then I would expect some kind of consolidation before further downside. Okay. Alright, so that's all playing off of a breakout from the current consolidation and sort of the current congestion between a couple of trend lines. Okay, let's take a look at the Euro Pound, which continues to be in ranging market. Here's the 4-hour chart. There's no direction in the 4-hour chart. You have the 200 moving average here sideways, price whipping back and forth across it, all the other moving averages as well. The RSI, 70, 30, 70, it just doesn't have any pattern of direction. Okay, so it's going to be tough again to play these levels within the larger consolidation, but you see it did respect the support here around 0.8470. Okay. Now, is it going to respect resistance once it comes up here again to tag 0.8590, 0.86 area? I can't say yes or no, but hey, you can give it a try, right? This has been resistance, and the market is not bullish. The market is bearish. The market is sideways in the 4-hour chart. Okay, it might be a little bullish if you look at the daily chart and look back. Look back before 2013, yeah. But in 2013, the market has been sideways. Okay, so in a sideways market, RSI at 70, maybe it shows you a bearish divergence like this here. Right? Bearish divergence at a previous resistance area in a sideways market. That's enough reason, just technically enough reason to try to play that resistance. Play some oversold condition, overbought condition. Okay, so now from there, my target potentially could come down to 0.8470 area, but I would say conservatively anticipated to just come back to the middle. What I mean practically by that is if it does come back to the middle and you see it struggling, you might want to lock in some profit, put in a trailing stop, for example. Now we saw the last couple of times, if it comes back down and it holds below 0.8560, for example, Just looking at the previous couple of times when the market came down from that resistance towards the middle, and you see some reaction, right? So if it comes back in the middle and you see some kind of the market stalling, maybe you put a stop, bring your stop closer to price and trail it just above 85.60. So you will lock in some slight. It would be very slight, maybe 15 pips. Okay, but 15 pips is better than if the market decides that, hey, it wants to continue to attack this top, and maybe it does elbow its way out a little bit before falling down. So now you risk that loss when you could have locked it in at a point of uncertainty. Okay, so again, this is just how I would consider playing the range. Okay, now that we no longer here at the range bottom, we're looking at the range top coming off of this rally. Okay, so some things to look for: bearish divergence, target the middle of the range before your first trade management to lock it in. And hey, maybe you get lucky, the market doesn't wipe you out before continuing falling. But now, so your scenarios, if you locked it in, would be either a 15 pip gain, or if you get a little bit lucky and it doesn't hit your stop, then you come down to what is this, 120 pips, something like that. Okay. Yes, about 120 pips. So, you'd rather have those choices, both of them are gains. One is small, one is large, than two choices, which is one is large, one is a loss. Right? Okay, so moving on from Euro Pound, I'm going to take a look at gold. Gold has been, in my opinion, sort of an easy ride for if you want to go short. It's been an easy ride. Okay, the breakouts to the downside have been effective. If you just play, for example, you have these. First of all, you trade this market with a bearish bias because going back in the 4-hour chart, daily chart, very bearish. RSI held below 60 and continues to tag 30. Bearish, bearish, bearish. A little bit oversold now though. So you might want to wait for it to consolidate a bit, and then either try to catch it at the consolidation top if it comes back to that, or if it's a good enough consolidation and it breaks to the downside, play that break to the downside. It's what's been working so far, and it's been working in that. Let's say this consolidation here, you establish the bottom twice, and then the top twice, and then you break down. The market didn't come back. If you sold on the break, the market didn't come back up to wipe your stop before falling further. That's what I mean. It's relatively an easy breakout play. Here, you might, if you get caught here with the false break, initial false break, and you don't put your stop above the middle of the range, right? I talk about after the range is broken, if you put the stop above the middle essential pivot of that range, if it respects that, right? You see here resistance. Let me zoom in. I don't want to have you guys squint. So we're talking about this area. We're just talking about breakouts right now, and where to put the stop after the breakout. You could put it above the middle of that range that's broken. Now you look at the middle, especially when you do see some pivots. Some resistance here, support here. Okay, now you put that, and this came awfully close. It would have been a scare. And then you have a break, and here we go again. You have a range set up, first with this correction swing, and then a swing down, and then when it came back up and showed respect to the middle, that shows a little bit of bearish bias. Okay, but the key thing here is, okay, fine, you have a bearish bias, and then you see the market sort of set up a range, and when that broke, okay, especially it actually broke before the FOMC reaction. Now, the FOMC reaction would have been sort of like you sold on the break, and then you see the FOMC reaction, which would have made you very happy, and it continued here. Okay, so this is another break, and this break again didn't come back up. For this break, I wouldn't have to put the stop above the middle. I would put that above this pivot here. Maybe above 1400. Okay. Above this resistance here. Okay. So on this break, I'm looking for 1200. Psychological handle, 1200. And the market just continues to plummet here. Gold market continues to plummet. It's again oversold, so now again you might want to wait for it to consolidate. Bring the RSI, resolve the oversold condition in your RSI, in your 4-hour in your daily chart, and even maybe in your 4-hour chart. It's a bit oversold. Let's go down to the 1-hour chart. The 1-hour chart's resolved, so in the very short term you could still break lower. And let's take a look at this one then. This little consolidation here. Slightly lower highs. The low is pretty much the same. So now if it breaks below 1221, look for it to go to 1200. Okay. Now, is this worth it? Let's say it goes to 1220, and you get in, you put the stop above this 1237, 1238, let's say 1241. It might not be worth it. It's like a 1-to-1 reward to risk if your target is 1200. Okay, but you have the trend on your back, and I would say, when you look at a trade, you start with 1-to-1, and then you look at potential. Okay, so in this weekly chart, you see next support pivots down here, 1158, 1168, somewhere around there are the next key support pivots from May to the July 2010 low. Okay, so you do have some room to fall further, and that might give you a reason why you wouldn't mind doing the 1-to-1. But, if you don't like that 1-to-1, then you can risk missing this short by anticipating a pullback and getting back in, maybe not at 1237, but maybe like 1235. That way you limit your risk a little bit, okay, and you would have a better reward to risk. But the trade-off is you might miss a sharp continuation. So I'm not here to tell you what decision you should make. Sometimes you see that if it's an FOMC and taper talk kind of thing, if it's some tomorrow's the last Friday of this month, but let's say if tomorrow is next Friday and there's non-farm payroll, and non-farm payroll is good, the dollar strengthens, then I might anticipate a more sharper decline. You might have to look at the factor behind the move as well to determine if you want to wait for the pullback. Okay, so I can't predict right now what those factors will be when there's a break. Okay, but if it's very good U.S. jobs data, for example, then the break can be a fast one, especially if it's during the U.S. session, during a high volatility period in that overlap session. U.S. European session. Okay, so that's gold, and I believe I'm going to wrap it up there and see if you guys have any questions. Okay, I do see. Okay, Euro yen making dollar yen making a move, right? Is that what you're saying, Chabelle? Yen crosses seem to be bearish at the moment. Okay, we saw that before. Does the quarter theory work on gold? The quarter theory. Are you talking about breaking up a range into quarters? I break the range sometimes into thirds, and I look at the top third, middle third, and the bottom third. I mean, if it works, it's not just particularly on gold, and if it doesn't work, it's not going to be particularly not on gold and work for other currencies. So I think, when you look at the range, I look at it either half-half, the top half, second half, or I will look at thirds, okay? And by thirds, I mean, the theory is that you don't want to trade, you don't want to sell at the bottom third of a range, or you don't want to buy at the top third of a range. So let's go to, dollar yen, for example, okay? When we break up this range, let's go to the 15-minute chart so you can see it larger. Okay. So if you break this up in thirds, okay, it's sort of I'm just kind of eyeing it right now. Top third, middle, bottom third. So during the bottom third of the range, you're looking at only bullish trades. Top third of the range, you're only looking at bearish trades. Middle third, you're sort of just standing aside, because the middle of a range sort of represents the neutral or equilibrium price, right? When the market oscillates in the middle, and this 15-minute chart is a good representation because all the moving averages are also sort of in the middle third, and that would represent a sideways market. But now you have some bullish bias, though it's still within the range. So people are still going to trade it, so shorting it here at the top of of this range. And that's why, if you want to play that bullish bias, you still want to see the market fade a little bit and consider it, if not at the bottom, at least in the middle. The middle is where you're sort of on the side. But if you have that bullish bias, you still want to wait until it comes back to the middle before operating with your bullish bias. If you're operating with your bullish bias in the top third, you risk this type of resistance. That's pretty much it for that theory. In daily chart, show euro still not break below 130 level. Aha! Wow, so while we're talking, we see another push. Again, we see resistance here at 1.3055, right? It's becoming more and more an important pivot. Sometimes, you want to just gather clues like that. This is a key pivot, so if it breaks, okay, maybe, if it breaks, we could come back up to 131, maybe even 131.50. Okay, but for now, this is still holding. And I want to see it establish a range. If it comes back, there is a slight possibility of looking for support here, but I would only consider that if this market broke already and then comes back down. So if it breaks this pivot, it shows me that it's possible that the bulls are taking over in this near term, okay, in the short near term. And if that's true, then I would expect the market to defend these lows, maybe even as early as 1.30. Okay, and so you might risk some further. If you see the market come down here, you could risk maybe 30 pips for a pullback at least 50 pips, maybe even 100 pips back up to these highs here, or this pivot here. Okay, so after the break, we could plan on buying on the dip, but before the break, just wait. I would just wait for more clues. If it goes like this again, comes back up, and it breaks, then okay, I might try to buy on the break, or if it comes back down again, put a buy order above the middle of this range. So once it sets up a range, then it'll give me more ideas on how to play the breakout. But before the range, when it looks a little bit naked, I like to just wait for those boundaries to be set up by the market. And how do you normally deal with expanding triangles? Expanding triangles are probably the most frustrating, type of markets to deal with. Okay, and I would say, it's going to happen. It's going to happen where the market chops you up, give you false breaks, in both directions. Now, that happens when sometimes it happens when there's a or that happens after a narrowing of volatility. So when you see the market, sort of get tentative, and then the volatility dies, and then the breakout happens, I would warn against, putting all your eggs in the basket of the breakout. Because when it breaks out from low volatility, it could just be a breakout of volatility without direction yet. It could, like you said, get into that expanding type of triangle or expanding range. Okay, so if it's coming out of a low volatility, be careful. Be more tighter in your trade management. So you basically, how I would deal with it in general is you have to have different types of trade management for different scenarios. A breakout into the trend, I would be more aggressive. A breakout against the trend, less aggressive. And it's up to you to define how to be more aggressive and less aggressive. Some of the ways are your position size, right? When you break into the trend, I have more confidence, and I would have a larger position size. If the market, goes in consolidation and then breaks against the trend, my position size is smaller. But it could build into larger position size if that new trend starts to confirm. But you start with a small position size because you're not sure if this reversal is a pullback or an actual reversal. Another way to have a strategy, conservative versus aggressive, is your trade management. When you're in a conservative mode, you might lock it in or break even early, or you might even take profit early. You might take profit in the first swing you see, because that's after that swing it's pretty much a crapshoot, right? Sometimes you have to understand what the edge is. After that swing, you have no more edge. If you're predicting that swing and you have a swing already in that direction, it might not go all the way to your target, but even if it goes halfway to your target, for example, that could have been the swing that you were predicting or forecasting, and it's just a different magnitude. So, again, conservative, tighter trade management, smaller position. And that will wrap it up pretty much at the end of the hour. Thanks for the reminder there. And that is it for today. Thank you for your question and attention. Once again, you can follow me at www.fxtimes.com. Thank you, FX Street, for setting up these webinars. And I will be back in July. So thanks again, everyone. Trade well, trade safe.